We are opening today's deep dive with the biggest macro story in fixed income right now. The 10-year Treasury yield has surged to 4.74%, sitting at its highest level in years and forcing every portfolio manager on the street to ask the same question. Is this the entry point, or is there more pain ahead? Two camps of strategists are openly disagreeing on that answer this morning, and the stakes could not be higher. The move is not just a bond story. It ripples directly into equity valuations, sector rotation, and where capital flows next. Let us break down exactly what is driving this and who gets hurt. The 10-year Treasury yield is printing at 4.74% this morning, up 0.89 basis points on the session, according to our live market snapshot. That places it at a level that has not been sustained in years, and the move is not noise. It reflects a structural repricing of what the market believes the federal funds rate will average over the next decade. Prior consensus had been for gradual normalization toward lower rates, but that thesis is being unwound in real time. Barclays strategists, who are among the most closely watched fixed income voices on the street, are assessing current bond valuations as fair, but critically, not yet cheap enough to represent compelling buying value at these levels. Here is the real driver beneath the headline number. The bond market is embedding federal funds rate expectations averaging above 4.0% across the full 10-year horizon. That is not a short-term spike. It is a structural recalibration of the entire rate path. When the market prices in persistently restrictive policy for a decade, duration becomes genuinely dangerous. The term premium, the extra compensation investors demand for holding long bonds over rolling short-term bills, has been rising alongside yields, which is why Barclays is signaling that the sell-off may have further to run before bonds offer sufficient compensation for both duration risk and the lingering uncertainty around inflation. Fair value is not the same as a buying opportunity. The immediate casualties are long-duration Treasury ETFs. Long-term Treasuries and TLH face direct price compression as yields rise, and if the 10-year pushes toward 5.0%, both ETFs would test critical recent lows. On the equity side, the S&P 500 and the Nasdaq 100 are both vulnerable, but the real vulnerability is in the Nasdaq's composition, which is loaded with high multiple, long-duration growth names that reprice sharply when discount rates move. The Dow is holding up better given its value tilt. Sector rotation is also decisive. Financials benefit from wider net interest margins, while utilities, REITs, and consumer staples, all treated as bond proxies, face capital outflows as the 10-year competes more aggressively for yield-seeking dollars. The key technical level to watch is 4.90% on the 10-year Treasury yield, a sustained break above that would signal an aggressive second leg of repricing that even the more bearish strategists have not fully priced in. On the equity side, the S&P 500 support level at the 7,600 index level becomes the line in the sand if yields continue higher. The Nasdaq 100 is more vulnerable given its duration sensitivity. On the bull side, a reversion in yields below 4.50% would immediately flip the narrative toward a dovish Fed pivot, boosting long-term Treasuries and TLH and re-anchoring equity multiples. Gold futures are climbing meaningfully this morning, which tells you real money hedgers are not waiting. They are moving now. Barclays' fair but not cheap assessment at 4.74% is a deliberate signal. There is limited margin of safety for bond buyers stepping in right now, and the path of least resistance for yields remains higher until the Fed delivers a credible pivot or inflation data shifts decisively lower. For equity investors, that means valuation pressure is not behind us. It is ongoing, particularly for growth and megacap technology. The smart positioning acknowledges that short-duration fixed income and financial sector exposure hold up better in this environment than long-duration bonds or high-multiple tech. Watch Fed communications and any inflation surprises as your primary catalysts. That is the one story that defines the macro landscape heading into this week. If this kind of deep, analyst-level breakdown is what you want every single trading day, hit subscribe right now and ring the notification bell. We publish every morning before the open so you are always ahead of the move.